Welcome to Factful Finance. Did you know that 75% of actively managed funds underperform their benchmarks over the long term? If you're thinking about your financial future, it's essential to understand the difference between active and passive investing. Let's break it down so you can make the most informed decision for your portfolio. Before we dive in, a quick reminder. This video is for educational purposes only. For personalized advice, always consult with a professional. Active and passive investing are two distinct approaches to building a portfolio. In the world of finance, the difference is often likened to driving a car. Active investing is like being behind the wheel, navigating every turn, while passive investing is more about setting the cruise control and letting things run their course. Active investing means trying to beat the market by selecting individual stocks or assets, relying on research, analysis, and decision-making. This strategy involves actively monitoring and adjusting your investments based on market conditions. Managers or investors pick stocks they believe will outperform the broader market. A popular example is the famous hedge fund manager who picks and chooses stocks based on deep research and analysis. The goal here is to outperform market averages, but it comes at a cost. According to Morningstar, active funds tend to have higher fees than passive funds. On average, the fees can be about 1% higher, which may seem small but can add up significantly over time. So while the strategy may offer the potential for higher returns, the costs and risks are also higher. Additionally, over time, many active managers fail to consistently outperform the market after fees. On the flip side, passive investing is about tracking a market index, such as the S&P 500. Instead of trying to pick winning stocks, passive investors aim to mirror the performance of the market as a whole. ETFs and index funds are key players here. The strategy is to buy a wide variety of stocks or bonds that represent a broader segment of the market and hold them for the long term. Passive investing typically offers lower fees and lower maintenance, making it a popular choice for those who want to keep things simple. Let's take a look at a hypothetical example. Meet Lisa. Lisa is an active investor. She spends hours researching and selecting individual stocks, hoping to outperform the market. On the other hand, John is a passive investor. He buys shares in an S&P 500 index fund, which automatically tracks the top 500 companies in the US market. After 5 years, while Lisa's stock picks have had some big wins and losses, John's portfolio has steadily increased in line with the market. Here's the kicker. John's fees have been lower, and his risk has been more evenly spread. The simplicity of passive investing might not seem as thrilling, but it's a reliable way to grow wealth over time with less effort. Now you may be wondering, which approach is right for you? Well, if you're just starting out or don't have the time to monitor your investments closely, passive investing could be a smart choice. The low fees and reduced need for constant attention make it ideal for beginners or long-term investors. But if you have the time, expertise, and a higher risk tolerance, active investing could potentially offer higher rewards. Just be mindful of those extra fees. Ultimately, it all depends on your goals, risk appetite, and the time you can dedicate to managing your investments. Both strategies have their pros and cons, and it's possible to combine them for a more diversified approach. For example, you might use passive investing for long-term growth and active investing for higher risk opportunities. What's your investment strategy? Let us know in the comments. Thank you for joining us at Factful Finance. If you found this video helpful, please like, subscribe, and hit the bell to stay updated on all our latest insights. Take control of your financial future, one smart decision at a time.